Welcome everybody. This is the inaugural lecture of the Columbia Digital Finance Seminar Series that is jointly organized between the Columbia Business School and the Digital Finance Lab within the Business School and the Center for Digital Finance and Technologies within the Columbia School of Engineering. So it's an effort joined between engineering and the Columbia Business School. I would like to thank my co-organizer of the series, Professor Siamak Maulemi, for putting all this together and for bringing the series to this stage where we are ready to start, and we are ready to start with a great speaker. So also I would like to thank Eric Budish for agreeing to be the inaugural lecturers in this series. And I would like to make a quick introduction to Eric. I think pretty much most of the people who are familiar with market microstructure already know how good and how influential Eric has been, but let me say a few words. So Eric is currently the Paul Dermott Professor of Economics and Entrepreneurship at the Chicago Booth School of Business, and he has he's also a research associate at the NBR, and he has also a visiting appointment in the law school within the Chicago Booth. I think he's also well known for a number of contributions in market design and applications of financial markets, high frequency trading markets, ticket markets, and I personally know Eric for his very influential work on the arms race for high frequency trading, and I've been reading his paper with great interest, and I've used some of his results for my own research. And he recently has also expressed interest in blockchain. In fact, he has done very interesting work, and he's going to tell us something about his findings in the area of blockchain and decentralized trust. And of course, he has been recognized with several awards, including the Sloan Fellowship and a lot of other important recognitions from the community. So without further say, I would like to leave the floor to Eric, and thank you everybody for coming, and looking forward to an exciting session.
I should have invited my father here to hear you say all those nice things about me. Thank you. Thank you all for having me. Is the microphone's okay? Great. So yeah, thank you all for having me. I didn't realize I'd be your guinea pig inaugural speaker in the series, but I'm delighted to do so. And this is a paper I'm quite excited to tell you about. I've been circulated an early version of it in 2018, actually, and I've been working quite intensively on a better, fresher, more fully complete version over the last 9 months or so. So be excited to tell you about it and get your feedback. So from a scientific perspective, what Satoshi Nakamoto, the inventor of Bitcoin, invented is a new way of generating trust. And the trust is completely anonymous and decentralized. You see what I mean by those terms as we go. As distinct from more traditional sources of trust in economic institutions and transactions. Trust that emerges from rule of law, trust that emerges from reputations, trust that emerges from relationships, collateral and financial transactions, trusted intermediaries, and so forth. At a high level, what Nakamoto invented is this really quite elaborate and ingenious scheme combining ideas from computer science and economics to incentivize a large, anonymous, freely entering, freely exiting mass of computing power all around the world. And actually by decentralized, I sort of mean the free entry, free exit, to pay attention to and collectively maintain a data set. And this enables trust in this data set. And the computer science terminology for the invention is a permissionless consensus, so establishing consensus on a data set in a permissionless, free entry, free exit kind of manner. This invention, of course, enabled cryptocurrencies. Nakamoto is the inventor of Bitcoin, and the data structure maintained is called a blockchain. And it's not super widely appreciated. It's probably appreciated by this audience, but that the inventions are distinct, and actually the core scientific ingredients behind the data structure of a blockchain date back to the 80s and early 90s, whereas what Nakamoto invented is really a way of generating this permissionless, anonymous, decentralized trust in such a data structure. I don't think it's an understatement to say that Nakamoto's invention captured the world's attention. I don't say this lightly. One statistic is that at its recent peak, crypto assets, so Bitcoin, Ethereum, and all of the other crypto assets were valued at about $3 trillion. And you can debate whether how literally we take that number, but that's one statistic of importance. But even this number seems to understate just how much attention culturally, politically, and commercially we've been paying to blockchains and cryptocurrencies over the last, in the time since the interest really took off, really several years ago at this point. But the economic usefulness of blockchains and cryptocurrencies, I think, remains a somewhat open question. So to date, the majority of volume appears to be speculative. So one of the best-known scientific papers on this phenomenon is by Makarov and Schwarr, and they find that about 75% of all Bitcoin transaction volume can be traced to financial behavior, so speculative behavior, as opposed to an underlying economic use. And of the remaining 25%, about half looks like it's black market or some form of illegal activity. Ironically, a lot of the speculative volume is through cryptocurrency exchanges, so like Coinbase, which are trusted financial intermediaries. And what Nakamoto invented is a way of doing away with trusted financial intermediaries. It's sort of an irony at the heart of a lot of the use to date. Here's quotes from Treasury Secretary Yellen and SEC Chair Gensler, just describing these features of the use of blockchains to date. So not widely used as a transaction mechanism, often used for illicit finance and highly speculative. And Chair Gensler expresses similar sentiments. What I'm going to argue in this paper is that Bitcoin and Nakamoto's novel form of trust, so undeniably an ingenious scientific invention, I'm going to argue that they have serious economic limits, serious economic limitations. I'm ultimately going to suggest some skepticism that blockchain, at least in the Nakamoto form, will play a major role in the global economy and financial system. So the core of the argument is three equations. It's simple enough to teach advanced, sophisticated undergraduates. Equation one is a zero profits condition, so an economic free entry condition. What equation one tells us is that the amount of computing power that's going to maintain this ingenious novel form of trust is going to reflect compensation, reflect the compensation paid to the trust. This computing power is called miners. So it's a free entry condition in the mining market. Equation two is an incentive compatibility condition, what economists call incentive compatibility. And what it asks is how much trust does a given level of computing power produce? And the well-known vulnerability of decentralized consensus is to some form of majority attack. So going back to work I've been learning about mostly through Tim's amazing YouTube videos, which I can, I guess, heartily endorse. The computer science literature on consensus is known for a long time. The consensus relies on there not being too large a fraction of attackers. Not too large of a fraction of the nodes maintaining the trust or acting in a Byzantine or dishonest fashion. So the vulnerability for Bitcoin is to what's called majority attack, the 51% majority of the system attacking the trust. And incentive compatibility tells us that the costs of attack must be larger than the benefits of attack. The damning conclusion is when you string these two equations together, you get a third equation that tells us that the compensation to miners, given the zero profit condition, for maintaining the blockchain has to be large relative to the benefits of attacking the blockchain. This is sort of a flow stock problem because the compensation to miners looks like a flow. It's an every 10 minutes compensation or every few hours compensation. But the value of attacking the system is sort of like a stock. You can think of as if I could compromise Visa, how much money could I successfully get away with? And that's a stock-like quantity. Or if I could rob a bank, how much money could I get away with? That's a stock-like quantity. So the flow cost of the trust has to be large relative to a stock of how much you could abscond with if you could attack the system. It's just a very expensive form of trust, especially as the stakes grow. There's a linearity to equation 3 that says as the value of attacking the system grows, the cost of securing it grows as well, all linearly. And the intuition behind this result is that this novel form of trust invented by Nakamoto is memoryless. The system is as secure as the amount of computing power maintaining it right now, the amount of compute this 10 minutes. Whereas most traditional forms of trust in the economy, think about trust in Columbia University or trust in Visa, they have some memory to it, whether it's a reputation or whether it's memory that relates to rule of law or to collateral. Blockchain trust as invented by Nakamoto is extremely memoryless, and that's what makes it only as secure as the flow cost of securing the system. Under frictionless, idealized attack circumstances, I get an even stronger result, which I'll call a zero net attack cost theorem, which says that in a kind of frictionless vacuum, the net cost of attack is in some sense ought to be zero, which sounds a little nuts and leads me to my next slide. So if this is right, why hasn't, and I'm arguing Bitcoin hasn't been that economically useful yet, and that might explain to some extent why it hasn't been attacked yet. But if the cost is really as low as I've argued on the previous slide, why hasn't it been attacked yet? So I'll jokingly call this the Chicago lunch table question, because if I tell my colleagues that this argument, they're like, well, why hasn't, if you're so smart, Professor Budish, why hasn't it been attacked already? So there's a way out of my argument, which itself is, I think, kind of problematic. But it's a way out of the argument that Nakamoto trust is extremely expensive is if, first of all, the technology used to maintain the trust is specialized. So it's what economists call a relationship-specific investment, or a specific investment. So it can only be used for mining Bitcoin. And second, an attack of the system would not only allow the attacker to abscond with some funds, double spend, for instance, but would actually cause a collapse of the trust, and with that cause a collapse of the value of the specialized capital. Because that makes an attack much more expensive. It makes the attack cost something like a stock, the value of the specialized capital, and not the flow, the per 10 minutes or per hour or per day cost of using the specialized capital. And this actually makes a dramatic difference in the magnitude of costs, on the order of three to four orders of magnitudes. This is actually good news about security costs, and it's my lunch table answer to the question of why Bitcoin hasn't been attacked yet, nor have the other major cryptocurrencies. There have been some attacks of smaller ones, but not of the significant ones. But vulnerability to collapse is itself kind of a big deal, especially if we're thinking about cryptocurrencies playing a larger role in the global economic and financial systems. I call this a pick your poison result. You're stuck with either large implicit taxes on using this novel form of trust, or you're stuck with conceding some vulnerability to economic collapse. And the analysis will point to some specific collapse scenarios to worry about, which I'll get to time permitting towards the end. A disclaimer, I have no clue, and I don't attempt to model where Bitcoin's price comes from. This is another thing that could get you fired from my university, of having a really confident view of the value of any particular cryptocurrency. I'm arguing that I don't have an explanation for asset value. I'm arguing that economic usefulness of this particular form of trust is likely to continue to be limited. And I think it's natural to link low usefulness to low value, but these are separable things. And as I mentioned, there's a lot of behavior to date is speculative and is through centralized crypto exchanges, which itself I think is kind of, I don't quite get that. I find that pattern puzzling, but it's separate from what I'm going to try to argue in my paper. So let me give you kind of an overview of where this is going. I'm going to give a very brief overview of the mechanics of the Nakamoto blockchain. Just given the nature of the seminar series and the sophistication of this audience, I'm going to mostly assume familiarity. I'll just highlight a few points that are relevant for what follows. I'll then go through the critique of Nakamoto blockchain in the three equations, and I'll go over the zero net attack cost theorem. And I'll do that with some level of formality. I'll go through an analysis of double spending attacks. I'll then go through the way out of the argument using the combination of specialized capital and collapse risk, and then I'll describe some open questions, some of which I'm working hard at the moment, some of which I think would be terrific questions for graduate students or others interested in the area. All right, so what is the Nakamoto blockchain? I'm going to assume familiarity with the basics. So a transaction consists of a sender, receiver, an amount, signature, and fees. Transactions are secured by cryptography. What Nakamoto worried about is how can we build a data structure of transactions where we're essentially not worried about double spending it, not worried about someone adding a transaction and then subsequently deleting it or sending the same money to multiple parties at the same time. A Google spreadsheet of cryptographically signed transactions would not do the trick. A spreadsheet maintained by a trusted party of cryptographically signed transactions would do the trick, but would require a trusted party. What Nakamoto invented is an elaborate construction to create what you could think of as a secured spreadsheet of cryptographically signed transactions in a data structure called the blockchain. Again, I'm going to assume familiarity with this. I'm going to skip through these slides very quickly. Transactions start by going into a data structure called the mempool, which you can think of as a holding tank of transactions about to be added. Transactions then get added to the blockchain in blocks of transactions, where a block is valid if each individual transaction in it is properly cryptographically signed. The same money doesn't go to two parties at the same time, and each transaction is funded given history. So if I send $1 to Larry, I have that dollar based on history, and I don't simultaneously send the same money to Siamak. Here's a visual of what I just described. Where Nakamoto's invention really comes in, and again, the blockchain data structure dates back to the early 90s, at least in terms of the core scientific ingredients. Where Nakamoto's invention comes in is starting on this slide, which is how do we create trust in a data structure with this form. It's really two related innovations. So the first is this computational tournament for adding new blocks of transactions to the blockchain, to this data structure. And it boils down to what economists call a rent-seeking tournament, a massive brute force search for a lucky random number. Anyone can play. To play, you find a block of transactions that you'd like to add to the data structure, hunt for a lucky random number such that when that block of transactions and that lucky random number, when it's all hashed together, spits out a bunch of zeros. So this is a hash from a recent block that's got 19 leading zeros. That's a 1 out of 16 to the 19 outcomes. So it just takes a lot of brute force work to find a lucky enough random number. If I find a lucky random number, I broadcast what I found. Others can quickly check that I've done so, and then go on to working on the next block. And my reward for finding a lucky random number, for mining a block, is I get rewarded with new Bitcoins plus transaction fees. At the moment, that's about $150,000 per 10 minutes, so about $1 million per hour. At recent peaks, it was almost $500,000 per 10 minutes, so about $3 million per hour. So it's a lot of incentive to join this lucky random number party. Here's a visual of that. The last piece of describing Nakamoto is the longest chain convention. So once I find a lucky random number and announce my block of transactions and claim a reward and claim that we should all start working on the next block of transactions, you all are supposed to start working on the next block of transactions too. And to coordinate behavior to coordinate on this behavior, Nakamoto proposed something called the longest chain convention. That the official consensus record of transactions is the longest chain as measured by the amount of computational work behind it. And I'll give you two related intuitions for this proposal, or this convention. So the first intuition is, as long as a majority of the computational power is behaving honestly, is behaving according to this longest chain protocol, the longest chain is going to stay the longest chain. Right? If we're up to block 100, and most of us are working on block 101, and then most of us start working on block 102, even if a few of us are rogue and are working on block 87 prime for some reason, the longest chain is going to stay the longest chain. So what makes the Bitcoin blockchain the official consensus record of transactions is that it's the longest. I could spin up an alternative blockchain starting from Bitcoin's Genesis block on my laptop. Let's call that the Budish blockchain. What makes that not official is just there isn't a lot of work behind it. So the longest chain as measured by computational work, that's the official record of what happened. A second kind of cousin intuition is you need some decentralized rule that coordinates mining efforts. And there have been a number of papers that have shown formally that longest chain honest mining is a Nash equilibrium of the game that comes out of Nakamoto consensus, if everybody's small. So if we assume away the possibility of attack. But no, longest chain consensus is intrinsically vulnerable to some kind of majority attack. So if all of you are working on the longest chain, block 101, block 102, block 103, but there's an attacker who has more computational power than all of you combined, that attacker can make a different chain that's longer with probability 1. In the same way that if you go to Vegas, the house will get all your money if you play long enough with probability 1. And as I mentioned earlier, it's not surprising that there's a vulnerability. Vulnerability to majority attack is just an intrinsic feature of these kinds of decentralized consensus models. Yes, Gur?
Why do you call this an attack? Here's the majority, you own the same.
So we could call it...
Minority could attack, but the majority are it.
So a different way of saying a majority could attack is if I have a majority, I am truth, right? I can create an alternative. In Nakamoto's view, whatever a majority...
You're the show, you're a majority, you're the show.
I'll show you the kinds of attacks I'm specifically worried about as we go. The attack I'm specifically worried about is, let's say I have a majority, I send you a bunch of Bitcoins, you send me a bunch of real goods or assets. I send you $1 billion worth of Bitcoins, you send me $1 billion worth of treasury bonds, and then I use my majority to subsequently remove that transaction from the longest chain. So that's, and to Gur's question, I'm just behaving the way, I'm behaving the way the protocol says we should behave. So I call that, I mean, if you did that to Goldman Sachs, they'd be pissed. But no, let me hold that thought. You're right. There's a sort of voting element to decentralized consensus where whatever a majority of the proof of the computational work or whatever a majority of the stake believes to be true is in some sense true. You kind of can't get around that if you're trying to establish consensus in a decentralized way. Whereas with traditional sources of trust, we can sometimes get around that. Majorities will have power, but they're not arbitrary power in a way. So what did Nakamoto achieve? Let me read actually directly from the abstract to highlight the accomplishment and its vulnerability. We propose a solution to the double spending problem using a peer-to-peer network. The network timestamps transactions by hashing them into an ongoing chain of hash-based proof of work, forming a record that can't be changed without redoing all of the work. The longest chain serves not only as proof of the sequence of events, but proof that it came from the largest pool of computer power. As long as a majority of computer power is controlled by nodes that are not cooperating to attack the network, they'll generate the longest chain and outpace attackers. So the accomplishment and its vulnerability, the accomplishment is anonymous decentralized trust. The vulnerability is majority attack, and that's what I'm going to try to express with my economic modeling framework. A couple quick clarifications. So first, many of you have probably heard about the heard the phrase used the phrase blockchain used in contexts where the trust is coming from familiar sources like major financial institutions. Here's a great quote by Matt Levine. If you announce that you're updating the database software used by a consortium of banks to track derivatives trades, New York Times will not write an article about it. You say that you are blockchaining the blockchain software used by a blockchain of blockchains to blockchains, the New York Times will blockchain a blockchain about it. And I'm going to be economically skeptical of the novel form of trust in Nakamoto, not distributed databases and distributed ledgers, which is kind of a self-evidently useful form of database in some circumstances. Second clarification is nothing in the description is specific to the fact that the transactions are sending currency. Smart contracts you can think of as just more generally a snippet of codes cryptographically signed by a sender. But the argument kind of extends to smart contracts. And then third, I think kind of most top of mind for many in this room is proof of stake as opposed to proof of work. And I'll talk about this more at the end of the talk. But roughly, instead of voting for the correct chain with computational work, vote for what's the correct chain with stake in the cryptocurrency. And Ethereum famously switched to proof of stake last month, very, very recently. You'll often see proof of stake motivated by its reduction in environmental externalities. You'll see headlines like Ethereum reduces its energy use by 99.95%. And actually Chipotle ran, did any of you get the burrito? They ran an ad called Proof of Stake, S-T-E-A-K, and you could get 99.95% off your burrito. The environmental issue is, I think, important, but totally separate from the concerns raised in this paper. What to me is interesting about proof of stake from the perspective of this paper is that stakes have some memory to them. So this opens up possibilities for making attacks more expensive. And I'll come back to this at the end after I go through my analysis of proof of work. So far, there isn't a silver bullet solution. Proof of stake Ethereum, for instance, does make double spending attacks more expensive, but other kinds of attacks remain kind of cheap. All right, so let me get into the mathematical modeling. So the first equation, the conceptual question behind it is how much computational power will maintain Nakamoto's trust if we're focused just on honest behavior. And this is going to be a simple zero profits condition. So I'm going to model this in a formal, somewhat price theoretic way. I'll also provide a one-shot game theoretic alternative, which I think in some ways might even be a cleaner teaching model. I'll go through both. They're very similar economics. So let's treat time as continuous. Capital N, the amount of computational power, is the variable I'm after. I'm going to assume that there's a large finite number of honest miners. They're going to follow the longest chain protocol automatically. What player I does, their only decision is how much computing power to choose. I'm going to call that decision variable x little I. And capital N is the sum of the x little i's. The equilibrium concept I'll define on the next slide is going to be a zero profit condition. And this captures everything's permissionless, free entry, free exit. Little p is the compensation per block paid to the miner that wins the computational tournament. I'm going to purposely treat this as an exogenous parameter. My whole point is going to be to derive constraints on this compensation, on this cost of the trust in relationship to the value of a tax. Proportional rule means that my likelihood of getting the prize in any particular block is directly proportional to my share of the computing power. So if I have little xi, I get little xi over capital N share of the computing power. That's my likelihood of winning the next block. And then the cost of running computing power, I'll denote little c. That's the cost per unit time. And this is going to be a rental cost of capital plus a variable cost like electricity. So I'll use the notation little c and think of that as a rental cost on capital big C plus any variable costs like electricity. All right, capital D is what I'll call the block difficulty level. So this is a feature of Nakamoto that allows the system to calibrate to one block per 10 minutes, whether there's a vast amount of computing power or just a few laptops running. So capital D is the number of units of compute time needed in expectation to solve one block. So that's enough to define honest miner profits, kind of on a per unit time basis. So if there's n units of computing power, the difficulty is capital D, somebody's solving a block every d over n time. So if n is 1 and d is 2, it takes 2 units of time on average to solve a block. Any 1 unit is solving a block per unit time, 1 over n times d over n of the time. And they're paying, any 1 unit is paying little c per unit of cost. So now I'm defining a zero profit equilibrium. I'll say a zero profit honest mining equilibrium consists of quantities and a difficulty level such that miners solve 1 block per unit time. That's a normalization. A unit time you can think of as like 10 minutes. And everybody earns 0 economic profits and expectation. So the result is that in any honest mining equilibrium, the difficulty level is going to calibrate to the amount of computing power. So that, again, 1 is a normalization, but you kind of see the economics there, hopefully. And then this is the key equation, n star c equals p. What that says is the prize per block in the computational tournament is exactly dissipated by entry into competing for the prize. And that's a standard characterization of rent-seeking tournaments. Agostino was talking about my work on high-frequency trading. The similar equations show up there. It also significantly predates my work. There's many other papers that have versions of equation 1 in them. And if we use Nash equilibrium for entry rather than a zero profit condition, you'll get n star c a shade less than little p. There's kind of some profits at the margin if we have a finite number of players. All right, so let's go to equation 2. So the conceptual question is, how much security does n star units of computational power generate? And the vulnerability is that an attacker with more than n star units of computational power can double spend with certainty, can attack the system. So what does an attack cost? I'm going to think about, at first, an additional player I'll call the attacker, not restricted to honest play. They can attack by choosing capital A n star units of computational power, A strictly greater than 1, so they have a majority. So if A is 1 1/4, for example, I have 1 1/4 out of 2 1/4 of the total. That's like 5/9, so 55%. Their cost per unit time is A times n star times little c. Attacks take time. I'll let the duration of an attack take t of A time. And I'll derive a closed form for that for double spending attacks soon. So A times n star c times t of A is what I'll call the gross cost of attack. The attacker can be clever about the size of their majority to minimize that gross cost. I'll call that that variable A star. All right, let's let V be the value of an attack. And for now, I'm going to think of this in the abstract too. I'm sort of, I guess, I'm not cheating. I think I'm doing it on purpose. But I'm thinking of P and V as exogenous parameters and deriving constraints in relationship to each other. That's kind of the whole point of the exercise. We should have in the back of our mind that the value of attacking the system will grow as Bitcoin's economic importance and usefulness grow. Okay, so the incentive compatibility condition is that the costs of attack, so the size of the attacker's computational power times the flow cost of computational power times how much time it takes, has to be large relative to the value of an attack. So a few remarks about this incentive compatibility condition. So first of all, this is studying an outsider attacker. So an attacker that's coming in from the outside, an overwhelming n star of honest compute power. An inside attack would be cheaper. It would cost as little as half as much. I use an outside attacker. It seems more attractive conceptually. The Nakamoto ideal is permissionless, decentralized, all participants small. So having an honest mass of computing power that's like an atomless continuum that behaves automatically, fluctuates with the size of the prize, that sort of seems like the right way to capture the spirit of Nakamoto. That said, an inside attacker might be more realistic. It's cheaper and they already have the computational equipment. So if you're thinking about, if your mind's already going to, well, what about all the ASICs you need to attack? An inside attacker seems more worrisome in practice. And then 2 is that's a gross cost of attack. And I'll talk about a net cost in a few slides. That's where the zero cost theorem is going to come from. All right, so the problem is if you string these 2 equations together, you'll see that n star c, the $100,000 per 10 minutes or the $1 million per hour, shows up in both equations and allows us to link them together. And these two equations imply a third that's kind of damning. It says that the per block payment to miners has to be large relative to the value of attack, with this constant term lurking in the denominator. I'll quantify that in simulations. But in words, the equilibrium flow payment to miners for maintaining the trust has to be large relative to the benefits of attacking the system. Make a couple remarks on this equation. So first, as I've probably said too many times already, it's a very expensive form of trust because it's memoryless. So usually trust comes from rule of law or reputations. Imagine a brand that was only as trustworthy as how much it spent on advertising today. Or imagine a country that was only as secure as the number of its soldiers on its border right now, right? Manhattan isn't as secure as the number of soldiers on the perimeter of Manhattan Island, right? If somehow an attacker was approaching Manhattan Island, that would inspire a response in which we scaled up the defenses of Manhattan Island. Right? The security models are usually less memoryless. Bitcoin, in a way, is always prepared for a maximum possible attack, but that also makes it vulnerable. Imagine if users of Visa had to pay fees to Visa every hour that were large relative to the value of a successful one-off attack on Visa. From a security perspective, the critique is that it's all linear. So if we take, if we take the attack up here, if we multiply that by 1,000, to keep the system secure, we have to multiply the flow payment to the miners by 1,000 as well. Where does security usually come from? Cryptography, rule of law, and so forth. So it's a really cool and ingenious, but very expensive trust model. Yes, please.
It's hard to follow everything that you just said, but the A star doesn't scale with V.
A star is going to be it's just the parameter of the size of the attacker's majority. So think of A star as like 1 1/4. T might scale because if you can attack Bitcoin for trillions of dollars, you might use a longer escrow period, and that's going to cause the time it takes to do an attack to grow. But it's not going to scale with V, and I'll show you simulations. I gotta speed up a little bit. I talk too leisurely, but you'll see where that. I'll analyze those concept terms in detail. All right, let me give you a zero theorem. So the net cost of attack is different from the gross cost for 3 reasons. So one is the attacker actually gets compensated for their attack in the form of block rewards. An A attacker who mines for T time performs a lot of compute, AT times N star units of work, so they earn block rewards for that. Second reason is an attacker might face frictions relative to honest miners. I'm going to throw a parameter into the analysis, kappa, that allows for the possibility that the attacker's computing power is less efficient than the average honest miner's computing power, or it takes time to stop and start the attack, and so forth. And then third, the attack, and I think this is probably the most substantive friction, the attack might harm the post-attack value of Bitcoin, which would reduce the value of any block rewards I've earned, and would also reduce the value of any Bitcoins that I've recovered in a double spending attack. So I'll let delta attack parameterize this decline. So here's a result. If all of these frictions go to 0, so if the attacker's cost is the same as the honest miners, the attacker gets all of the block rewards that they'd get if difficulty does not adjust, the difficulty doesn't scale up to reflect the size of the attacker's majority, and the attack doesn't cause the value of Bitcoin to fall, then the net cost of attack is 0. I'll skip the proof. Let me just give you the intuition, which is that the attacker is fully compensated for their computational costs for the same reason the honest miners are fully compensated for their computational costs. This is kind of what Gore was getting at when he says the attacker is the honest miners. It says, who are you to say what's true and what's attack? An implication is this isn't important like the Modigliani-Miller theorem, or it's certainly not as important. I think it's a good result, but I think it's useful in an analogous way, which is zero theorems we don't take literally, but they tell us that frictions must be important in practice. So here it's telling us that frictions in the attacker's cost model or harm to Bitcoin have to be part of the protection of Bitcoin. Here's a one-shot game version of these equations. And I think I'm gonna go to about another 20, 25 minutes. Is that right? I might skip this, and I'll go through this very quickly in the interest of time. So some of the complexity in the analysis relates to timing issues that are specific to Bitcoin. But here's a simplified one-shot game that I think captures the essence. Let's say there's I nodes. A node does work or stake or so forth. A node chooses a quantity, little xi, and a posture, which could be honest or attack. Costs are C per node, per unit. So let n be defined as before, just the sum of the xi's. Payoffs are if there's a player I with a majority and their posture is an attack, they get V attack. Else, each player gets their proportional share of this one-shot prize. This is the game I would set up if I was teaching this to advanced undergraduates. So here's the question, under what conditions is there a Nash equilibrium of this one-shot game in which everybody chooses honest? And some quantity is consistent with Nash equilibrium. So a lemma and a theorem, the lemma is if there is an honest equilibrium, then we better not be losing money relative to this prize, so n star C less than or equal to P. And then a theorem is that a necessary condition for there to be no profitable attack is that P has to be greater than the value of an attack divided by a small constant term, 1 over 1 plus the number of players. Here's the proof. I'm going to skip this in the interest of time. As the number of potential players goes to infinity, the condition is just P greater than or equal to V. And the interpretation of this version of the game is that P and C now represent a unit, the payment to miners per unit time and the cost per unit time commensurate with how long attacks takes. It's kind of the analog of this A star, T of A star thing above. All right, so let me do some analysis of double spending attacks and then give you my way out of this argument. So majority attackers, what can they and can't they do? They can't steal all the Bitcoins. Right? Bitcoins are cryptographically secured. What they can do is they can add transactions to the blockchain and subsequently remove them, or they can reverse recent history. So the specific attack that Nakamoto seemed to be most worried about was a double spending attack. Let me show you that visually. So we're up to this block, so that's block 1,000,000 or block 100. In the next block, say block 101, I send a bunch of Bitcoin to financial institutions. I wait for an escrow period. Current escrow periods are typically 6 blocks. They might be longer for large transactions, but I wait an escrow period. After that escrow period, the financial institutions release their assets to the attacker. They now feel secure that they've received the Bitcoins. In parallel, the attacker is mining their own private chain. They send those same Bitcoins to themselves, to a cousin account. They make their private chain longer than the honest chain, which they can do with probability 1, and they can make it much longer. I'm going to analyze making it 1 block longer to take longest chain protocol literally, but they can make it much longer if they want. And then they release their alternative longer chain. And this is now the official record, taking Nakamoto literally and seriously. This is the longest chain official record. And in this official record, the attacker has their own Bitcoins, but the banks off-chain have sent treasury bonds to the attacker or have sent other goods or services, assets to the attacker. Okay, so to analyze the constraints that double spending places on the system, let's think about equation 3 from before. So the benefits from attack, I'm going to do sensitivity analysis across a broad range of values. The way I think about this parameter is that a double spender against Bitcoin is not going to double spend for a cappuccino. But they're going to double spend for an amount of transaction volume that is as large as possible given current use cases of the system. So I think of V-attack as a statistic on the amount of transaction volume that honest users can conduct in a short period of time. I'll be a little loose what I mean by short period of time, but that's economically how I think about it. The duration of attack I can compute explicitly, and then I'll ask how big does little p have to be to secure a desired amount, capital V. All right, so the duration of attack we can solve in closed form. Let me just skip this formula altogether other than to note that it grows with the escrow period and it shrinks with the attacker majority. So if you take the attacker majority to be really large, it's basically 1 plus the escrow period. Here are some computations from that formula. me call your attention here. If the escrow period is 6 blocks, which is fairly typical, and my attacker majority is 5/9, so I have 1.25 as much compute power as the honest, it's going to take me on average 12.5 blocks worth of time for my attack to succeed. So my attack succeeds when the escrow period has lapsed and I'm longer than the honest chain. If the escrow period's really long, the attack's going to take commensurately longer. Gross cost of attack, I'll skip. I'll go through a few different cases for the duration of attacks, kind of informed by the computations. My base case will be that A times T is 16, which corresponds to A of 1.25, so 55% attacker majority, and current escrow periods, and doesn't sort of assumes that frictions and block rewards kind of cancel each other out. Also consider an expensive case, which is about 10 times the base case, and a very expensive case where the attack takes a full week of compute costs. All right, so first, some base case results. So the per block cost of securing the system is 6.25% of the value secured. So if the value secured is $1,000, the per block cost has to be 6.25% of $1,000. If the value secured is $1 billion, the per block cost of security is 6.25% of that. And that follows directly from equation 3, just reorganized slightly. The major difficulty is how costs scale with time, so from per block to per day to per year, and with the size of the attack possibilities. So a $100 billion attack to secure against that requires $300 trillion per year, which is 4 times global economic output. So it's kind of a crazy number. And the reason it scales this way is it's sort of related to that military metaphor I was describing. The Bitcoin blockchain has to always be as secure as the largest possible use of the system. That's like the perimeter of Manhattan always being ready for Putin to launch the nukes. Right? Instead, we'd look for, I guess I shouldn't say that on video, but we'd look for signs that an attack is coming and then scale up. Right, that's just not, a common sense attack models aren't, you're always prepared for the worst case scenario and not prepared for an epsilon worse than the worst case scenario. The percent tax looks a lot more reasonable on a per transaction basis. The per transaction cost of security is 0.003% of the amount secured. But the thing to keep in mind is this is a percentage of the maximum possible attack paid on a per transaction basis. So take this seriously. If I buy a cappuccino with Bitcoin, I've got to pay 0.003% of Putin's nuclear attack. Right? So it scales really badly even on a per transaction basis. The sensitivity analysis improves the picture a bit, and by 1 to 2 orders of magnitude. So on a per block basis, it could be as little as 0.1% of the value secured. But it still scales badly, and again, with time and with the value secured. So even if the attack takes a full week, which is the very expensive case, it requires an annual expense of 52 times the amount secured to secure so 52 billion to secure $1 billion attack, or $500 per transaction. So some takeaways, it's completely consistent with modest use cases of Bitcoin, like computer parts or Silk Road or online gambling. It's also consistent with large-scale black market use cases, because black market users might be willing to pay a lot. But it casts doubt on the use of Bitcoin as a big component of global finance. And also, I think this was surprising to the computer scientists I've talked to. To secure the system for large transactions requires implicit tax rates that are prohibitive for smaller transactions. Another surprise, I think, to the computer scientists I've talked to is that a long enough escrow period isn't protective enough. And I think that the thing that comes naturally out of this way of thinking about the problem is that you need to think about the value of an attack kind of endogenously. Like, if Bitcoin becomes more economically useful, then will it be secure? Whereas thinking about current use cases and saying, like, oh, if we make the escrow period long enough, we're good, is sort of missing this if-then reasoning that I'm trying to emphasize in this paper. All right, so let me get you out of this argument. So the obvious response to a double spending attack, yes?
Related to the last statement you made, previous slide.
Yes.
So this is Exactly. This seems to basically indicate that basically the fee that we need seems related to the statement that if you need to execute on blockchain, then you need to pay a fee to get priority. And regardless of whether you're executing a large transaction or a small transaction, you still have to pay the same fee, right? So it doesn't really, it's not proportional to how much you are trading, but more to the priority that you want to get.
Yeah, I'm kind of analyzing fees. It's funny. I was talking about this with a colleague earlier. I think a lot of why this analysis might feel different from how we currently think about the cost of using Bitcoin today is most of the compensation to miners comes in the form of new Bitcoins. So it's sort of like inflation tax or seigniorage tax. We don't really feel it. So if I use Bitcoin to buy a cappuccino at Starbucks, it doesn't actually feel that expensive. But implicitly, I'm paying for, in holding Bitcoins, I'm paying for this 10 to $15 billion a year of computational expense, and I'm treating that as part of P-block. All right, so let me get you out of this argument. So a double spending attack would certainly be noticed if I sent $1 billion worth of Bitcoin to Goldman Sachs and then undid that transaction by sending those same Bitcoins to a cousin account. They'd notice, they'd call the feds. It would cause a decline in the value of Bitcoin, possibly, which the attacker is left with after a double spending attack. So the Bitcoin Wiki actually classifies majority tagging, I think it's still up there, as probably not a problem for this reason. So, and it's kind of correct in a logical way that if Bitcoin falls by delta attack as a result of a double spending attack, and that delta attack parameter is large enough, it's actually not incentive compatible to double spend. Because I send $1 billion to Goldman Sachs, $1 billion of Bitcoin, recover $1 billion of treasury bonds, and the $1 billion of Bitcoin. If Bitcoin falls to zero, I didn't really accomplish anything. Yes?
To sort of build in your military analogy, like if it became the way we transact in our economy and you had an adversary who wanted to destroy our economic system, they wouldn't necessarily care that, they'd spend as much money as they could and they don't care that the value of Bitcoin loses. Their V attack comes from exogenous.
So thank you for setting up my next bullet point.
You can pay me in Bitcoin.
Yeah, I'm kind of poor. I'm Bitcoin poor. I'm 10-year rich, Bitcoin poor. So, this might sound reassuring. I mean, there's a proposition that formalizes this. But it concedes, as you were just pointing out, that this vulnerability to dramatic fall in the value of Bitcoin. So this is why I call it a pick your poison result. You're either stuck with high tax rates or some risk of economic collapse. And what might a collapse argument be motivated by? It's sort of hard to say exactly, but it seems like the magnitudes might already be quite large relative to the gross costs of attacking the system. Futures markets, last I checked, were about $20 billion of open interest. Bitcoin's market cap was as high as $1 trillion. It's a recent quote from Vitalik Buterin, the inventor of Ethereum. Just considered normal for there to be trillion-dollar assets that are managed on Ethereum. So a sabotage attack could be quite highly motivated. But a sabotage attack, so an attack motivated by a collapse of the system, arguably would cost a stock, not a flow, and thus be a lot more expensive. So let me walk you through that part of the argument. So Nakamoto, in the original paper from 2008, envisioned ordinary computers solving these computational riddles. But for almost 10 years, very specialized machines called ASICs, application-specific integrated circuits, have been doing essentially all Bitcoin mining. And they're not just a little bit more efficient than your laptop, they're 10,000 to 100,000 times more efficient than you are on my laptop. Because if you take a hash function, my computer can do all sorts of stuff, including SHA-256 hashing. If you build a computer where the only thing it can do is SHA-256, and you program that directly into hardware, it's going to be a lot more efficient at that. It's sort of like how high-frequency traders will sometimes program very specific trading strategies directly onto hardware. That makes it's less flexible, but it's faster. So if the capital is specialized and the attack causes a collapse of the system, you got to charge the attacker for the value of their specialized capital. So I'll call that N star capital C, where that's the fixed cost of the capital, not the rental cost of the capital. Here's a picture of one of these ASICs. from a company called Bitmain. At recent hash rate, it'll be about $15 billion of capital to match at just retail prices to match the hash rate. If you controlled all of Amazon Web Services, as a fun statistic, and you devoted it to Bitcoin mining, you'd have about 0.05% of Bitcoin's hash rate. Because Amazon Web Services computers can do all sorts of stuff, but that makes them a lot less efficient at Bitcoin mining. So even though it's worth quite a lot of money, it wouldn't really get you very far. It's very specific capital. So you can then rederive equations 1 through 3 with specialized capital and collapse risk. So equation 1 is before, but we're now thinking of C as a rental cost of capital and a variable cost. Equation 2, I'm going to modify to the cost of attack is I have to have at least n star units of specialized capital that will, let's say, vanish to 0 in value if I attack the thing. And then you'll see C shows up here and here. So you can kind of solve out for P block as a function of C. And you get this equation down here where n star C equals P block times mu is the capital share. So it's how much of the cost is capital and how much is electricity. And then an interest rate, little r, where the interest rate is the per block interest rate. So it can be quite small. I'll come back to that in a second. So we can derive a modified version of equation 3, where P has to be large relative to the value of attack, but now there's this little r lingering in front of capital V. And this is much smaller than before because little r is the per block interest rate. So even if annual interest rates are like 50%, the per block interest rate is something like 0.001%, or I might even be off by a 0. It's tiny. So just a sense of magnitudes, if we plug in the base case, use a 50% discount plus, 50% is a really high interest rate, but I'm thinking of depreciation and risk as well. You get a 2,500 times change in the rewards necessary for security. And these values also roughly plug to the cost at retail prices of matching the current hash rate. So the annual cost to secure $1 billion in the original model was 3.3 trillion. In this sabotage model with collapse, it's 1 or 2 billion. And the current capital stock suggests Bitcoin secure up to sabotage is worth roughly $10 billion for an outsider, $5 billion for an insider. So we kind of have this candidate answer to my lunch table question of why Bitcoin hasn't been attacked yet. It's the specialized equipment. The attackers would lose the stock value of their specialized equipment because an attack would cause the system to collapse. And this stock value is actually pretty expensive. It's billions of dollars, and causing a sabotage of Bitcoin must not be worth billions of dollars. Probably worth a lot, but must not be worth $10 billion. So suppose I'm right, and the Bitcoin blockchain actually does not satisfy the flow cost incentive compatibility constraint, but does satisfy the stock cost incentive compatibility constraint. And an attack would cause the system to collapse. So then the question I want to ask, and this will kind of be like my last piece of analysis, and I'll go to some open questions, is what changes to the economic environment would cause us to switch from the incentive constraint that we do satisfy to the incentive constraint that would be violated, or cause the incentive constraint that we're currently satisfying to stop holding. So one scenario is just changes in the chip market. So if there's a glut of, I'll sort of skip some of the details on the slide in the interest of time, but if an attacker could get their hands on a large quantity of good enough chips, maybe not cutting edge chips, but good enough chips at a very low price, that would make the cost of attack more like a rental cost than a flow cost. At the moment, there's no particular reason to think that there's a large quantity of recently stale ASICs on the market, but this could change. And I think more generally, if your security depends on specialized chips, then you got to be really paranoid about changes in the chip market. Second scenario is just a sufficient fall, sort of similar economics, but I think a different kind of vector to worry about, a sufficient fall in the compensation to miners. So we have this equation 1 from before where n star times the flow cost of compute has to be equal to the block reward. If the block reward falls by a lot, some computers are going to turn off. Right, so there's some math that expresses that on this bullet point. If it falls by enough that you wouldn't want to pay, even if the computer were free, you wouldn't want to pay the electricity cost, some computers are going to get shut off. So if enough capital is mothballed for a long enough period of time, this would seem like it could raise vectors for attack, where an attacker could get their hands on a lot of cheap chips. Also, the rewards to miners are decreasing over time. So currently you get 6.25 Bitcoins for solving a block. By 2044, it's going to be less than 0.1 Bitcoin. So either Bitcoin's value has to grow a lot. I guess transaction fees could grow a lot. That's another possible salvage. Or there's going to be a lot of mothballed capital. So here's just, by 2032 at current prices, ballpark 85% of capital might be mothballed. And then the third scenario, kind of logically, is if Bitcoin grows in economic importance relative to its current cost. So just for logical completeness, I want to mention this. If Bitcoin were to grow enough in economic importance to tempt a saboteur, even at the cost of $10-ish billion. There have been a lot of 51% attacks. None of them have been for the major cryptocurrencies. The closest have been Ethereum Classic and Bitcoin Gold. There's a Bitcoin Gold attack several years ago for $18 million. None of these are for significant amounts of money. Where there have been significant successful attacks on crypto is not through 51% attacks directly, but through just various kinds of DeFi hacks. Some of these are the economic equivalent of stealing a password. One that I'll highlight that I think kind of has a flavor of 51% is the attack on Beanstalk, where an attacker rented using a flash loan a 51% majority of the coin in a DeFi project, used that majority to vote on a proposal to donate $250,000 to the Ukraine. Buried in that proposal was code that siphoned off a large amount of funds to the attacker, who then caused a collapse of the Beanstalk system. So that had a 51% flavor. A few other ones in this list have a little bit of a 51% flavor. And there have been a lot of collapses, too. I'll highlight Celsius. This has nothing to do with my paper, but it's kind of good banking theory, I guess in honor of Doug Diamond. So here's the balance sheet of Celsius. This is from August 2021. They have about $1 billion of equity, $18 billion of liabilities. They're promising 8% returns to their account holders, and they have $19 billion of assets diversified across a wide range of crypto activities. So if you have 19-to-1 leverage at 8% interest across diversified, really risky stuff, you're vulnerable to a bank run. That's what happened. They collapsed on bankrupt. All right, so let me close with a couple open questions, and then I will wrap. So the open question that I'm most excited about, and I'm like trying desperately to frame or answer, is whether there's some solution to the problem that I've identified with Nakamoto Trust in its original form, whether there's some alternative way to generate anonymous, decentralized-ish trust in a data set that's less economically limited. So there's work by my colleague Jacob Leschno and Tim Roughgarden, who's here, that provides some useful shape on the problem space. So axioms that relate to decentralization imply Nakamoto's compensation scheme. So we get something like N star C equals P as being intrinsic to this kind of trust. Vulnerability to majority attack also seems intrinsic to this kind of trust, just given what we know from the past computer science theory of distributed consensus. Let's say an attack is cheap if it costs a flow. Let's say an attack is expensive if it costs a stock, so if it costs something commensurate with the fixed cost of capital. And the question is there a blockchain protocol that makes all attacks expensive without reliance on a collapse argument? So without reliance on an attack causing the capital to fall in value from capital C to 0. So traditional forms of trust solve this problem very easily. So if I use capital C of collateral and lose the collateral if I cheat and it's enforced by rule of law, there's an opportunity cost of posting collateral. Can can secure the rule of law work. If rule of law works as intended, we're secure up to cheating worth the value of the collateral at a low cost. So you can secure a stock at the cost of a flow. Let me sort of close by talking about what Ethereum does and does not accomplish with respect to this question. So the usual motivation for proof of stake, as I mentioned, is the environmental harm of proof of work. What I'm excited about is the way that stakes can make attacks more expensive, taking advantage of stakes having some memory to them. You can tell whether the same stake behaved well or badly over time. So what Ethereum does is, in the event of a double spending attack, so in the event that I sign off on transaction A and then sign off on transaction A prime that conflicts, it confiscates, this is the new proof of stake system they've just adopted, it confiscates the attacker's stake. It's called slashing. It takes advantage of observability of the attacker signing conflicting transactions with their stakes. This makes the cost of double spending a stock, not a flow. So the contrast versus the Bitcoin model. So Bitcoin, for it to cost the stock to keep the system secure, requires what I'll call untargeted slashing. All compute power has to go to zero. All ASICs have to lose their value for the attack to be expensive. Whereas Ethereum uses what I'll call targeted slashing. They call it slashing. You only have to confiscate the attacker's stake for it to be expensive. So you don't need an implicit assumption of collapse to keep the system secure. This is great, but Ethereum raises some new issues. Proof of stake raises some new issues not faced by Bitcoin. Mostly I'm worried about liveness attacks. So in its current form, at least, you could halt Ethereum for a long period of time for a relatively small amount of money. So that just doesn't seem like it's ready for prime time for global finance, but just I'm quite excited about this open question. There's a lot of other interesting open questions. I'm kind of at time, so I'm going to skip some of the other interesting open questions, other than just to advertise. I'll post the slides publicly. But one is just figuring out if there's something interesting about blockchain with traditional trust. I think there's a lot of interesting questions in finance about the speculative behavior or using it as a way to study how Bitcoin got off the ground in the first place. There's fascinating policy questions. But let me just conclude. So Nakamoto invented a new form of trust, which is anonymous and decentralized. My conclusion is ingenious but expensive. Equation 3 tells us for the trust to be meaningful, the flow cost of running the blockchain has to be large relative to the one-shot value of attacking the system. So payments to miners have to be large relative to the highest value uses of Bitcoin. It's like a large tax. To get around this argument, that the attack costs more than this flow cost, you need to concede that security relies on specialized computers and that the system's vulnerable to outright collapse. They call this a pick your poison conclusion. And then I can point to some specific collapse scenarios. So the overall message is that there's intrinsic limits to how economically important Bitcoin can become, because if it gets important enough, it'll get attacked. And I'll emphasize it's completely consistent with black market uses of Bitcoin and Nakamoto trust, and also the analysis is completely consistent with the use of distributed ledgers secured by traditional forms of trust, like the blockchaining a blockchain Matt Levine was joking about. But what this paper highlights is exactly what's so ingenious and novel about Bitcoin and Nakamoto trust that might make it economically limited. It's just a really expensive trust model. Let me stop there. I'm happy to take questions, and thank you for your time and attention.
So I think this is very interesting, by the way, but when you talk about that the deterrent for the attack is the collapse of the price of all Bitcoins by somewhat, I think you're missing the likely possibility that the double spent Bitcoins themselves would be rendered worthless instantly either by social consensus, which already happens with things like when exchanges get hacked, that those coins get blacklisted, or given like the fundamental assault that a double spend on Bitcoin or 51% attack would be, the rest of the network would immediately not immediately, but when they organize it, would just fork and make those coins worthless.
And at the same time, Goldman Sachs would try to recoup the treasuries that it sold for those assets. And potentially the miner that did all this might face criminal prosecution.
Yes, I'm very sympathetic to the argument you just made. You invoked rule of law, and you evoke social consensus. So I think those are both traditional. This rule of law, especially, is a traditional form of trust. I've heard a lot of a lot of critics of this paper rely on a rule of law argument, which at some level is ironic, right? Bitcoin is valuable for its ability to create trust without trusted financial intermediaries, without rule of law. But if the shit goes down, let's call in the feds. Like, it kind of has, that argument kind of has that flavor, but I think it might be right. I think it's absolutely right that if Goldman Sachs got double spent, they'd call in the feds and they'd find, take whatever means necessary to recover the treasuries.
Which would make the attacker who think twice, because if they have 51% of the mining power, they can just mine honestly and make money and not risk going to jail.
Yeah, I think the way I take, let me make one other comment on this. I think it's a really interesting question, which I think that you've highlighted a real conundrum for policymakers, which is Bitcoin is currently very useful for black market activities, and there's a lot of implicit legal puts on attacks using Bitcoin. So if I were to steal your crypto wallet, for example, I'd be committing a crime, and you'd be protected by rule of law. If I were to double spend against Goldman Sachs would call in the feds. There's a lot of implicit legal puts, but at the same time, the system is really great for criminals, and really great for black market activity. I think that creates a conundrum for policymakers.
I don't want to hijack the conversation, but
I've been yapping for a long time. You can say whatever you want.
I strongly disagree with that. When people make comments like that, they act like the traditional financial system is not used for criminal activity, and it is to a shocking extent, despite the restrictions that are put in place. And two, just in the last couple of years, with the tools that these companies like Chainalysis have developed, and if you look at like the Bitfinex hackers or the people who were trying to money launder the Bitfinex hack and how the US government traced their activity on chain to figure out who they were, it's gotten really hard to use Bitcoin for that kind of criminal activity. I'm going to set aside like hacking, your cousin's wallet aside.
Yes, I mean, it's been used a lot for ransomware. That's what Chair Gensler and Secretary Yellen were talking about. And I think I could kind of concede the point, but I think it's also just true in the data that there's a large amount of Bitcoin activity can be traced to black markets. And then we're at time, but
I think
yeah.
let's close up the seminar here, and if you have other questions, you can come here and ask directly Eric. Thank you.
Thank you very much. I appreciate it.